Good morning, everyone, and welcome to the Morning Bell. I'm Robert, and it's Wednesday, February 11th, 2026. Joining me, as always, are Lizzie and Steve. We've got a lot to unpack today, from market volatility to some interesting earnings reports, and of course, the delayed January jobs report that's finally hitting today. Lizzie, let's start with what's been moving markets. What's catching your attention this morning?
Thanks, Robert. Well, the big story dominating conversations right now is this continued concern about the US consumer slowing down, which we're seeing reflected across multiple data points and corporate earnings. The Financial Times is calling it out directly, and we're seeing evidence in the retail and consumer goods space. When you look at companies like Kraft Heinz, they beat earnings expectations by 6 cents, but revenue actually fell short of estimates, which tells you they're managing costs well, but struggling with top-line growth. That's a classic sign of consumer pullback. We're also seeing this weakness play out in the automotive sector, with Penske Automotive missing earnings by 27 cents, which is a significant miss. What's particularly notable is how the market is interpreting all of this against the backdrop of a weaker dollar. Bloomberg has a whole piece on what a weaker US dollar means for the economy, and the short answer is it's a mixed bag. On one hand, it makes US exports more competitive, but on the other hand, it can signal concerns about US economic strength and potentially fuel inflation through higher import costs. The dollar weakness we're seeing today ahead of the jobs report is telling us that traders are positioning for data that might not be as strong as hoped. Gold is responding to all this uncertainty by rallying above $1,500 per ounce for the first time since January 30th, which is a clear flight to quality move. When you combine consumer weakness, dollar concerns, and safe haven buying, you're looking at a market that's genuinely nervous about what comes next. The selectivity in this market is becoming critical because not everything is moving in tandem anymore.
That consumer weakness theme is definitely something we need to watch closely. Steve, let's pivot to the economic data. Today's the big day with that delayed January jobs report finally being released. What's your read on the numbers and what should we be watching for?
Thanks, Robert. Today is indeed significant because we're finally getting the January jobs report that was delayed, and this data is absolutely critical for understanding the health of the labor market and what the Federal Reserve might be thinking about monetary policy. The consensus expectations are calling for moderate job growth, but there's a wide range of estimates from economists, which tells you there's genuine uncertainty about what this number will show. What makes this report particularly important is the context we're operating in. CNBC is reporting that healthcare has been propping up the job market, which means if you strip out healthcare hiring, the underlying labor market might be softer than headline numbers suggest. That's a concerning dynamic because it indicates narrow strength rather than broad-based economic health. We need to pay close attention not just to the headline payroll number, but also to the unemployment rate, labor force participation, and wage growth figures. Wage growth is especially important right now because if it's decelerating, that supports the consumer weakness narrative that Lizzie was discussing. Average hourly earnings growth has been trending down from its peaks, and if we see another step down in January, that's going to reinforce concerns about consumer spending power going forward. The other thing I'm watching is revisions to prior months, because we've seen some significant revisions in recent reports that have painted a different picture of labor market strength. If December gets revised down materially, that's going to add to the narrative that the economy is losing momentum. The market reaction to this data is going to be interesting because we're in this unusual situation where bad news might actually be bad news rather than good news for rate cuts, since the Fed has already been cutting and might be nearing the end of their easing cycle.
That's a nuanced picture, and you're right that the market's interpretation of this data has become more complex. Lizzie, let's talk about our stock of the day. We're looking at Micron technology, which has had an absolutely remarkable run. Walk us through what's happening there.
Micron is one of those stories that really captures what's been driving markets over the past year. This stock is up 298% over the past 12 months, nearly quadrupling in value, and it's still up over 18% year to date, even after pulling back from its highs. The company is currently trading at $373.25, which is about 18% below its 52-week high of $455. Now, when you first look at the valuation, it seems expensive with a trailing price-to-earnings ratio of 35, which is elevated for a semiconductor company. But here's where it gets interesting. The forward PE is only 8.6, which implies that analysts expect earnings to roughly quadruple from current levels. That's a massive earnings inflection, and it's being driven by the AI boom and specifically the demand for high-bandwidth memory chips that are essential for AI data centers. Gartner is forecasting a 47% increase in memory chip prices, and Micron's fiscal 2026 projections show revenue expected to double to $75.4 billion, with adjusted earnings per share expected to quadruple to $33.38. Those are extraordinary growth numbers. The challenge for investors right now is that the stock is already trading at $373 against an analyst consensus target of $382, which means there's only about 2.4% upside to current targets. So the stock has largely priced in the near-term positive story. The bull case here depends on whether this AI-driven memory boom extends beyond current expectations and whether analysts start raising their targets as these earnings materialize. The bear case is that we're late cycle in the memory chip boom-bust cycle. And after a nearly 300% gain, the stock is vulnerable to profit-taking or any disappointment in AI infrastructure spending. For traders, this is a momentum play that's running out of near-term catalysts, unless we get upward earnings revisions. For long-term investors, that forward PE of 8.6 suggests value if you believe in sustained AI spending, but you need conviction and tolerance for semiconductor volatility.
That's a thorough breakdown, and you're right that the risk-reward is getting trickier at these levels. Let's shift to crypto. Bitcoin and the broader crypto market have been under some pressure. What are you seeing there?
The crypto market is showing some bearish tendencies right now, with Bitcoin dropping 3% and trading below $67,000. What's particularly notable is that top Bitcoin traders are refusing to turn bullish despite Bitcoin's 14% rebound from recent lows, which tells you there's skepticism about whether this bounce has legs. The narrative around Bitcoin is also shifting in an interesting way. Grayscale put out research saying Bitcoin is trading like a growth asset rather than digital gold, which is significant because it means Bitcoin is correlating more with risk assets like tech stocks rather than acting as an inflation hedge or safe haven. That's problematic in an environment where growth assets are under pressure. On the positive side, spot Bitcoin ETFs added $167 million in inflows, nearly erasing last week's outflows. So there is still institutional interest. There's also some technical analysis suggesting a rare bullish signal that historically has preceded major rallies, potentially as much as 220%, but given the current market structure and trader positioning, I'd be cautious about putting too much weight on that. The key level to watch is $69,000. Bulls need to reclaim that level to shift momentum, and right now they're struggling to do so. Ethereum is in a different situation, trading below $2,000 but showing signs of accumulation by long-term holders, which suggests smart money might be building positions at these levels. Robinhood just launched an Ethereum Layer 2 testnet for tokenized assets, which is a positive development for the ecosystem. There's also technical analysis pointing to a large demand zone below $2,000, so if Ethereum holds above that level, we could see a bounce. Solana continues to show relative strength with positive sentiment around its ecosystem development. The overall crypto picture is mixed, with Bitcoin showing the most bearish characteristics, Ethereum at a potential inflection point, and Solana maintaining constructive sentiment. For crypto traders, this is an environment where you want to be selective and watch those key support levels closely rather than chasing momentum.
Well, that gives us a comprehensive view of what's happening across markets today. We've got consumer weakness concerns, a critical jobs report landing this morning, Micron trading near analyst targets after a massive run, and crypto markets showing some hesitation. It's one of those days where the data we get could really set the tone for the next few weeks. As always, the key is staying disciplined and not getting caught up in short-term noise. Focus on the fundamentals, watch those key levels Lizzie mentioned, and pay attention to how the market interprets today's employment data. Remember, do your own research and consult with financial advisors before making investment decisions. Thanks for joining us on The Morning Bell. I'm Robert, along with Lizzie and Steve. We'll see you tomorrow.